For me, the way I'm using the Magnificent Seven is I really like relative performance charts. So I run the Mag 7 versus the S&P 500, and it just gives me a direction because it's such a large piece of the S&P 500. Gives us a direction of where the overall market's going, and it does follow those seven to leadership. As you said, tired of hearing the name, but used as a statistical tool, it's extremely valuable. That relative performance chart helps us stay on sides, helps us understand which way the direction of the market's going. And those big seven are so interconnected with, I think, talking about the broader economy, they're so interconnected with what we do on a day-to-day basis that it does help us understand where the market's going.
Welcome to the Advisors Fuel podcast, where high-performing financial planners and wealth advisors discover proven processes and actionable strategies to elevate their client experience, grow their businesses faster, and achieve unprecedented success. Here's your host, Adam Tosh, founder at Adrenaline Advisor Consulting at adrenalineadvisor.com.
Podcast is designed to help financial advisors grow their practices, better serve their clients, and stay ahead of what's happening in the markets and in the industry. Today, we're joined by John Kosar and Jack Kosar of Asbury Research, a firm launched way back in 2005. They have more than 4 decades in total experience studying global financial markets, with John beginning his career on the trading floor of the Chicago Mercantile Exchange, and then going on to develop a reputation for blending technical analysis with macro market research to identify trends and opportunities in the markets. Jack is the Vice President of Investment Strategy at Asbury Research. He works with advisors and investors to translate Asbury's research into practical portfolio strategies and market insights that make sense, that are actionable and implementable, if that's a word. So together at Asbury Research, they provide data-driven market analysis, rules-based to help investors and advisors better understand what's happening beneath the surface of the market. So John and Jack, welcome back once again to the podcast.
Thanks for having us. Good to be here.
Yeah, we're going to be doing this quarterly. So we gave it a shot in first quarter, and it was a big hit. People really enjoyed it. So I think it's really important for advisors, investors as well, but advisors around the country to get some rules-based analysis that kind of cuts through all the noise and the mess. So it's like anytime something happens on CNBC, it's markets in turmoil. There's always something wrong. And I think that we need to not only as advisors understand what's really happening in the markets, but we also need to understand what to say in a way that actually makes sense to our clients so we can talk them off the ledge or otherwise, right? I've got some questions here, but kind of like last time, we're just going to kind of chit chat. This is probably going to go off the rails almost intentionally, but let's talk about the tape right now. S&P just printed fresh highs. It's working on its 6th straight winning streak, but breadth, when we look at our nerdy stuff that we look at X or comments on UBB boards or what have you, breadth continues to be the story all year. When you look under the hood, leadership, participation, momentum, what do you think? Does this rally still look like the real deal, or is something off here?
It does to me. And that's, I think, the advantage of looking at data instead of listening to the financial stations, which have to tell you that there's something really important to pay attention to all the time, because that's how they get paid, by getting people to watch them. But you've got all of the right parts of the market have been leading for really since April. I'd say probably since first week of April, maybe a little bit sooner than that. So you've got the NASDAQs are outperforming. The SOX, I just looked at a chart before we went on. The SOX over the past year, the SOX is the Philips Semiconductor Index. The SOX has outperformed the S&P 500 by 100% over the past year. That's been the constant. Even when earlier in the year, when you had the Mag 7 faded a little bit, they were underperforming. You had technology, both of the NASDAQs were underperforming. The stabilizing factor there was semiconductors. And now you've got MAGS is the ETF that we track, that the Mag 7, that's setting new highs. Most of those big AI related stocks that are up at the top of the list in terms of market cap, they've all set new highs over the past 2-3 weeks, including Apple, including Amazon, including Nvidia just a day or two ago. And then the burrows, as I call them, sure-footed burrows, which is where you go when you're afraid that the market's going to go down and managers need to have their money somewhere, stuff like the Dow, stuff like the NYSE. Those have been underperforming. So if you turn the TV off and you look at the chart, we're getting outperformance from all the right places. Is it funneled into a narrow group? Absolutely it is. But again, the bigger relationships reflect the bull market.
Yeah, I love that you mentioned the noise and the TV ratings. Something I've seen recently is this: people like to quote Michael Burry whenever things are going well, and now
Yeah.
Michael Burry is supposedly, I don't know how true it is, but he's got significant leveraged short positions in Oracle, Nvidia, Palantir. Palantir I may be able to understand. I haven't looked at an Oracle chart recently, but Nvidia, I don't know. It's one of those things where you get these people at the top of the market about once a month, and eventually they're right, and they're like, "Oh, he called it."
It's a
And then,
dangerous game to play.
and to be clear, all three of us on this call are agnostic as to whether the market's going up, down, or sideways. We don't care. With that, one of the things I know that you two are huge on, your bread and butter, is relative strength, rotation, money flows. What do you see out there that's quietly leading the market right now, but nobody's really talking about? And then maybe on the other side of the fence, if you want to answer the question, what's losing leadership that everybody's still in love with?
Oh man, I don't think it's quiet. Technology is leading the market. You had a ceasefire called a couple of months ago or a month ago or so, and all that money that was flowing overseas because it was a really hot topic to take your money and bring it over to Europe or bring it over to Asia, all that flowed right back, and it kind of flowed back into tech. I think the AI boom is still kind of roaring. We're starting to see revenue gains by the big tech companies. So I don't know if it's so quiet. I know we've been kind of watching semiconductors for quite a while. So even when the market was going sideways, semis were kind of that underlying support that we were seeing in the market for a while. But I don't think there's anything quiet about it. And I think energy is staying higher than people anticipated. There was this idea that it was going to spike. We're going to get a ceasefire and going to go away. But energy prices are remaining high. And between tech and energy right now, that's kind of where our sector rotation model is somewhat leaning.
It's interesting you mentioned semis doing well during the Iran drawdown. And I think that's another thing that's so important that many financial advisors probably don't know is one of the best times to perform analysis is when markets are declining, whether it be a pullback, a correction, or especially a crash. But drawdown analysis is simply when you take a look at the relative strength of all the different sectors, asset classes, subsectors, individual stocks, and you're trying to find out, okay, as this thing goes down, which stuff's doing the best, what's really holding up, so that when, not if, because inevitably it's going to turn around, but when it turns around, what do we want to latch onto on the way back up the hill, right? So gold pushing 4,700, oil keeps whipping around like a broken roller coaster on these Iran headlines. Bond yields don't really make a whole lot of sense. They're not really cooperating either. What's the one charter relationship that's screaming the loudest at you two right now?
Two things. The first one you mentioned is long-term interest rates. They're as high as they've been in a year and a half. I'm looking at the 10-year and the 30-year Treasury. I've got the 10-year here. I actually just pulled it up to cheat a little bit. So we see we're at 445. We're at a 445 yield on the 10-year, according to the SIBO 10-year Treasury Yield Index. The market, the bond market is pricing in inflation. It's pricing in what CPI and PPI were very hot earlier this week. You're starting to come up to levels in the 10 and the 30 in terms of yield, been the top of the range for a few years. So that to me, and again, I'm not going to put on a position because we strictly follow our models, but I do like to try to understand what's happening bigger picture. And I think that's a big deal. If those yields continue to rise, it's a signal from the bond market that inflation is happening. Whether you like it or not, or whether you choose to believe it or not, the bond market doesn't lie.
And none of us care about whether or not inflation happens and if that's going to affect the US dollar or how we pay off all this 40 plus trillion dollars of debt. But it is interesting at the end of the day. We want to have that conversation, but I've always felt that the way to get out of this debt is going to have to be to inflate our way out of it, because I don't know that we're going to make a phone call to China and Venezuela and say, hey, sorry, we're just not paying you back. We've just decided we're just going to call the debt. So I think that the average American is not going to have a clue what's happening. If inflation goes up, the dollar goes down, and we pay it off with cheap money. But I don't know if you have a comment on that, but like I said, going off the rails.
Bigger picture, I guess, like I said, new fresh highs in terms of the yield of the 10 and the 30-year Treasury. It's not going We are strictly data driven and we do what our models tell us to do. But where stuff like that is really useful is that helps you understand what your models are telling you. It helps you understand the context of why your model might be signaling to buy a certain security or be risk on or risk off. So I just like that context because it doesn't, I don't make any more money with it. If I'm in the model, I'm in the model, but it does help me to have a better understanding, big picture of what's going on in the market, what's
Yeah,
going on there.
it can invalidate or validate things. Like for me, small caps. I really like small caps and micros right now, but if interest rates were to go up too far or too fast, then that could end up being a problem for the smaller guys. But
Yep.
what about the concentration question? I mean, you touched on it a second ago, but Mag 7, I don't know about you two. I'm so sick of hearing that phrase, even Mag 7. It's so annoying to me. But and for those advisors or even investors that don't know what the Mag 7 are, they're the magnificent seven stocks: the Nvidia, Meta, Amazon, Google, Microsoft, Apple, and Tesla. I don't know what makes them so magnificent, but a
If you
hyperscaler.
want them in your portfolio, it does. If you have them in your portfolio,
Yeah,
that makes it magnificent.
it's so
Yeah.
exciting. Yeah. So the concentration discussion we were talking about earlier, that's back in the conversation. There's this recurring narrative that narrow leadership means that the market is fragile, and I think that probably, again, because it's not rules based, it's just news based. I think it scares people and it causes them to make bad decisions with their money. But Goldman flagging breadth is one of the narrowest readings since the dot-com era. So
Mhm.
it's, we as technicians, we as rules-based, data-driven people, what are your thoughts? Do you actually believe all this, or is it one of those things that people are worried about that the market just shrugs off until it doesn't?
For me, the way I'm using the Magnificent Seven is I really like relative performance charts. So I run the Mag 7 versus the S&P 500, and it just gives me a direction because it's such a large piece of the S&P 500. Gives us a direction of where the overall market's going, and it does follow those seven to leadership. As you said, tired of hearing the name, but used as a statistical tool, it's extremely valuable. That relative performance chart helps us stay on sides, helps us understand which way the direction of the market's going. And those big seven are so interconnected with, I think, talking about the broader economy. They're so interconnected with what we do on a day-to-day basis that it does help us understand where the market's going. Like you mentioned earlier, how many people called the top. We talked about, me and my dad were talking this the other day, how many people got buried at the bottom because they called the bottoms. And I think for us, as long as the train keeps chugging along, we're gonna follow our models, follow the data, follow that relative performance chart, and allow ourselves to make some money. Anecdotally, we have a lot of clients right now who are terrified of market correction, but at the same time are asking us how they can increase risk in their portfolio. And it's a weird dynamic as, hey, we want to make sure we protect our downside, but this thing could keep running. I think beyond a lot of the economics, beyond a lot of the hard financials that we see of fear and everything like that, the idea that people don't want to miss out on that top side keeps that money invested. And as long as we keep getting phone calls about increasing our risk, we can keep running because that means people are still throwing money at it. We track asset flows, and the asset flows for the 11 sector spiders, which break up basically the S&P 500 at all-time highs, and they continue to rise. So as much as there seems to be some fear here, people keep throwing their money into the market and investing in equities.
I think it's always like an interesting private sentiment indicator to just hear what our clients are saying. Because it's not until they start getting, I hate to use the word exuberant for obvious reasons, but it's not until they start getting super careless, complacent, and the market's just going to go up forever that I really start worrying. As long as people are concerned about risk, even if they're asking for more aggressive models, I think the market's probably in a decent place. But, and it's funny you mentioned picking the bottom in during the Iran decline. There was this hedge fund manager way back of, God, it was 2009, I think, that I met this hedge fund manager. He's doing this big presentation. I don't think he's in the business anymore, but he says that you should never try to pick your bottoms because only monkeys pick their bottoms.
Yeah.
Anyway, I don't know what the lesson is there, but
Key metaphor. Yeah.
what about Gann cycle, Elliott wave? These are almost like four-letter words in technical analysis these days. Nobody talks. I shouldn't say nobody. I might offend somebody. But Gann cycle, Elliott wave. This rhymes with 1999 analog charts calls that saying that this is in the process of a topping process right now. Is there anything in the current bear case, the bear camp, that genuinely looks to be at risk or giving us pause here?
Yeah, this is a pet topic of mine. So
Uh-oh.
I've been doing this a long time, 40, 43 years, I think, this year. And when I was still on the floor of the exchange and I wanted to get noticed. So I was in Chicago, right? So it's like you're off on another planet compared to,
Yep.
the friends that I had that worked in New York City, and it was a lot harder to be noticed. So you had to have a good suit, a good head of hair, and a crazy forecast, and you had a shot of getting on CNBC. The business to me is way too tilted towards forecasting. Is a euphemism for guessing. It gets you on TV, it gets your clients excited, maybe, I don't know. But where I've changed, shifted gears is the last 10 years, and Jack's been a big part of this because we backtest everything that we think works. Think. You don't know if something works unless you really do a thorough backtest of it. There's a lot of people, this is my favorite indicator. How often does it work? Or I don't know. It's just my favorite. It works for me. That's not enough.
Yeah.
We do is we don't forecast. We look at the data. We know what's important to us. We've built models, and I don't get paid any extra money if I forecast what's going to happen between now and October, or if I just follow my models, and that's going to get me there. Maybe it'll get me on CNBC. If I was a little younger and a little better looking, probably faster. But we just don't. I've moved away from the forecasting, and I make more money and I sleep better at night. So that's kind of evangelists about anything. That I think that's it. Don't forecast, read the data and do what it says.
And that's probably the number one thing that makes me the most angry about the perception of technical analysis is that I don't know who to blame, but I'm going to blame somebody at the risk of being, creating shock factor myself here. But I'm going to blame the mutual fund industry and say that it was them and maybe some of the ETF companies as well that came up with this concept that you need to stay in the market all the time. Greg Morris has written a lot about this, but it's why do you have to stay in the market all the time? And why is there so much analysis out there that teaches financial advisors to stay in the market? And if you don't, then your returns start to erode. And any financial advisor who's listening to this right now is going, yeah, of course. You have to look at the other side of the coin. You have to look at the research that was started by Paul Guyer back in the 80s. I did a redux on it in the 20 teens, and I was going to do another redux just last year. And the best days and the worst days typically fall within days of one another, and they happen all during times of high volatility. And that's what trend following is. That's what relative strength and technical analysis, it's all about avoiding, I always call it, staying invested in the playoff teams and avoiding the rest. And the industry, unfortunately, for financial advisors, many financial advisors, they've been trained, and I'm one of them, by the way. I was trained the same way, that we need to stay in the market all the time, because if you don't, then you're going to miss out somehow. And that market timing doesn't work. I hate that phrase because it insinuates that we're trying to predict the future. Nobody is. Nobody's trying to predict the future here, right? I just think it's important. I'm emailing back and forth somebody right now, essentially trying to convince him that technical analysis works. We've been using it for years, right? John and Jack, you guys for 40 years. For me, it's been since 2008. But it's so frustrating to me, research to convince financial advisors to do one thing which isn't the best for their clients. That's what really fires me up.
I agree. Totally agree. All the time, people think they hear it from their advisors, just regular investors, that time the markets, don't try. Nobody can time the market. So they're saying nobody can time the market. And I'm hearing I can't time the market. So we certainly don't want to let anybody know that there might be others out there that can. And can we do it all the time? No, but we can do it a whole lot of the time. That one of our models stays right with the S&P 500. You know it, it's a CDM model, but the drawdown is 40% less than the 500. And for most older investors, that's what they want. If I could just own the S&P 500 and not have my face ripped off when it drops 33%, so I can sleep at night and I can enjoy my retirement. That's what these guys want. They want to play the game with less risk, and that can be done. But I think there's way too much emphasis of you can't time the market, and God forbid, if you take your money in and out of the market at opportune times, the taxes are going to kill you. They get people afraid of moving their money in and out of the market, and they're terrified of taxes. And you know what? If you make money in the market and you have to pay taxes, that's not the worst thing in the world. The messaging, I think, that goes out to investors is really tilted towards just give me your money and shut up, and I'll send you an electronic birthday card once a year. And I think we could do better than that.
Yeah, I think I was going to wait to the end to say this, but think to the advisors that are watching or listening to this, think about what the incentive is for a brokerage firm of any kind to train their financial advisors how to manage money well. Are you going to bring in assets? If you own the brokerage firm, are your financial advisors going to work on prospecting and bringing in new AUM if they're focused on analyzing portfolio management, back testing signals, and so on and so forth? The
Exactly.
second question I have, and these are just rhetorical questions, you can come to your own conclusion. Then again, question for financial advisors: what is the incentive for any fund company, mutual fund, ETF, or otherwise, to suggest or do any research that suggests you ever sell? Let that sink in. And the thing is, you don't have to do it yourself. We're not saying that you have to learn a technical analysis and go start reading books by Edwards and McGee and figure this out yourself. The reason we're sharing this is because we're really passionate about it, and we've got SMAs on the Schwab platform. We've got money. Our models are if our models aren't on your TAMP, then we can very easily get on your TAMP if you're interested in it. Just reach out to send me an email, send John or Jack an email. We can work with your TAMP to get the models on there. But you'd be really impressed with what. But I digress. Like I said, I was going to wait to the end to say that. But let's talk about this AI stuff. So the bubble, right? The AI bubble is here, supposedly, right? It's the dominant retail question this year, even though retail keeps buying it anyway, right? So anyway, what are your thoughts there?
I keep hearing that it's rhyming with 1999. Again, now I was quite young during 1999, but I do a lot of reading. Analysts started calling the top and that there was a bubble in 1997. The market continued to rally from there for 2 extra years before we saw any kind of pop. There's a slight difference between AI and the dot-com bubble. A lot of these companies have a lot of capex, a lot of expenditures, and a lot of substance to them on the underlying, especially the bigger ones, versus a lot of the companies back in the 99 were a nice website with really no underlying business model. To say that it's not a bubble, a lot of really smart economists are out there saying that there needs to be a whole nother economy, a whole nother industry that opens up with AI for it to justify the spending with what you will. But there's always these booms and busts. You want the market to naturally behave this way, where money flows in, it gets excited, and then Darwin takes over. It picks the winners, and the losers go home, and then we grow a little bit stronger. Coming from a little bit of a younger generation, I think we've seen asset prices go straight up for a long time. And my generation as well wouldn't mind seeing a little bit of a correction so we can buy some of those assets cheaper. We could build our portfolios in my book a little bit here. If there is a bubble, that's what an economy is for. It's to let the cream rise to the top, and then we'll flush out what's left, and we'll move forward.
And speaking of the correction, what are your thoughts on a correction? I don't know if we saw a correction. What was the decline? 9 point something percent? Wasn't it technically 10%, which I don't know why we have to draw lines, but
the S&P 500, to all my studying, is a mean reverting animal. The market always has been. Over the last 10 or 15 years, the S&P 500, I think, was averaging about 11% a year. The last 3.5 years were somewhere north of 18 to 20%. Yep. I don't believe that's sustainable. I do believe we will revert to the mean at some point and come back a little bit closer to normal. But again, trying to call the tops. Michael Burry, what he's doing is he's got 2-year long put options. So he's not even short these stocks. He's taking a bet that sometime in the next 2 years, these long out of the money options are going to hit, and he's willing to make that bet. Do I think in the next 2 years that we could have a correction? Historical market data would tell me yes. When? I don't know. Our models are long right now because that's what the data is telling us. And when it decides to flip the other way, that's when we're going to go that way. But we had clients a year and a half ago tell us that the market was up 40% and there's no way it could climb higher. They were going to cash, and they missed out when they called us 6 months later and said, hey, we messed up. How do we get back involved with you guys? Yep. So until that merry-go-round stops, I think you got to stay on.
Yeah, I agree. And every correction starts with a pullback. Every crash starts with a correction. And something I've been saying for a long time is I don't even count. 2022 is tough, right? 2022, the S&P is down almost 20. The NASDAQ was down about 34, if I remember correctly. Bonds were down, depending on you're looking at the aggregate bond index, down 14 to 16. Then looking long-term treasuries, down 30-something%. So the only thing that really made money were commodities, energy stocks that year. Energy was a big winner. And I know that's something the Asbury models were focused in, which is one of the big reasons you guys had such a great year there. But if you take 22 out, if you take the COVID crash, which was so fast, I just don't think that we've seen anything like the dot-com bubble or the Great Recession. Market peaks in 2007 October, and it goes down 57.8% in 18 months. 57%, 58% we'll call it. We haven't seen anything like that in a while, and I think we'll see something like that eventually. None of the three of us have a clue when it's going to happen, but I think the point is we got to be careful not to get too arrogant. And if it's not arrogance, it's just overconfident. And because in my opinion, I've done other podcasts or been on podcasts where we're talking about how old you have to be today to have really experienced a true market crash. And what I mean by that is if you say the last big market crash, the last real one was, say, 2009, 7, 8, 9. In order to have really felt that, you have to be in your mid 40s. Because if it was your 20s, then think of the math. In 2009, how old were you? And when the market bottomed. And then let's just say you started college or you got out of college when you were 22 or 23 and it's 2009. You probably aren't even put money into a 401k yet, right? So it's not until maybe 2000, I don't know, 10 before your 401k is worth anything to where you really care whether it goes down a whole lot, because in dollars and cents, it's a 30% decline. It's no big deal in dollars and cents on my $12,000 401k. But when you start getting up there and you're in your 40s and all of a sudden your portfolio is starting to grow and now you're looking at really serious retirement dollars, it's been since, again, 2009, if you want to call it 2007, since we've seen a serious, just grueling, rip your face off kind of decline. And I think that investors and, more importantly, financial advisors need to be prepared for that. And that's where I like to talk about, again, trend following, technical analysis, and your CPM model. I don't know if you want to talk about how things went in 2022 or if you want to talk about anything like that, but I think it's important for people to know that you don't have to stay in the market, and this is how you do it.
Yeah, 2022 was a year for us. So we have two models. We have a sector rotation model. It's called CEIF. CEIF is an acronym. And these are the two benchmarks for us. And the other one I mentioned is CPM. It's a correction protection model. And in 22, it was down 18.9, 18.6. And a blend of both our sector rotation model and the risk on and risk off model, CPM, we ended up 8.6 or something on a 50% blend of those two models. So we outperformed by 30%. And the way we did that is when the market fell hard in the beginning of the year, we were in T-bills on the risk on and off model. So we were out of equities and we were in T-bills. But the other side, the sector rotation side, we moved into energy on the, I think, January 10th of that year, and we didn't get out until June 23rd, June 24th. And during that time, we outperformed the S&P by 40% by being overweight XLE. XLE outperforms SPY by like 40%. So that's the advantage. And again, when our model went overweight XLE in the second week of January, I had no clue that it was going to last for 5 months. I just knew that there was an aggressive chunk of money that went into XLE in multiple time frames. I didn't know why. I didn't know how long it would last, but that's where the money. We have a podcast that we call Following the Money, because to me, that's the game. The game isn't trying to rub your temples and trying to figure out what's going to happen 6 months from now or 9 months ago. Follow the money. Because the money's the boss. Now, there's other influences, of course. There's interest rates, and there's politics, and there's trade, and there's all these other things. But money is the boss. If you can figure out a way to track the money in a comprehensive way, you don't have to make forecasts. You don't have to know what's going to happen 6 months ahead. Believer in building tools that effectively let you be where the money is and be agile the way when the money changes its mind to go somewhere else.
Staying nimble, right? Yeah. To the advisors out there, as we wrap up, the listeners, people watching this podcast are advisors that are sitting across from nervous clients. If you two could give them one piece of advice, and I think you've already hit on it probably several times today, but what technically grounded advice could you give advisors that are sitting across the table from nervous clients to help them with the conversations they're having this next quarter? What would that be?
Turn the TV off, I think, to a large degree. People get nervous. Older people, I use this metaphor. I speak in metaphors to the chagrin of my kids, but I always compare it to football. When you're in the first half of your investment life, which Jack would be, it's dollar cost averaging. You could take chances. You could handle the ball, behind the line of scrimmage. You can do reversals. You can throw the ball downfield. You can take some chances. Once you have a lead and you're in the fourth quarter, which is me, I've got a lead. Financially, I don't want to give that back, but I still want to see if I can score again. I will, but I play the game differently. I think if you have the proper tools to do it, of course, but making your customers trust in the fact that you put defense first, what your advisor thinks today, or I'm not a big fan of the set it and forget it way to set up a portfolio. In the month of March, bonds dropped, gold dropped, and the S&P 500 dropped all at the same time. You don't get the desired result. So I think making them believe in a defensive approach that's driven by numbers rather than by emotion, I think goes a long way towards that.
Yeah, I think clients want to know that you're doing something, or that you have a plan, that you're going to do something about it if something changes and the market starts to go sideways, get chaotic. I think that, again, kind of going back to what I was saying earlier, you don't have to be a professional money manager with a bunch of alphabet soup after your name and be a market technician or an analyst of any kind. You just have to be open-minded enough to look at options that are tested, proven in the trenches, that have worked well over time, and then you can communicate those changes that you're making or that the portfolio is making. Just we have these conversations that we're doing in this podcast, for instance, but we have lots of conversations like this to kind of help give people talking points so they can calm their clients at a time when the last thing they should be doing is making a change and based on what they saw in the news, right? And if they feel like they need to turn off the news, but they can't because then they won't know what's going on in the political world, because if they don't know what's going on in the political world, then they won't know what to talk to their friends about, then they need new friends. Anyway. All right, I'm going to wrap up here. So thank you both. We're going to do this again in 3 months. This is fun. Always valuable to hear what you two are thinking about. 3 technicians sitting around the table here. And for those of you that are listening or watching, if you'd like to learn more about John and Jack, their work at Asbury Research, check out the links in the show notes for this episode, where we'll include their website, any additional resources, ways that you can get a hold of them for the sake of the SMAs at Schwab, if you're an advisor that clears through Schwab, or if you're not, how we can have a conversation about having their models added to your TAMP so you can be defensive and have a plan for when, not if, the next big correction or crash happens. As I always say, there's thousands and thousands of podcasts out there. You chose to spend your time with us. So thank you so much for listening, and we'll see you next time.
Thank you for tuning in to the Advisors Fuel podcast. For more articles, videos, and resources, or to schedule an intro call, visit adrenalineadvisor.com. This podcast is for informational purposes only and should not be relied upon as a basis for financial or legal advice. Always talk to your compliance department before implementing any of the ideas shared in this episode.